Financial professionals love Ethereum, and it's a very different story from Bitcoin. They see Bitcoin as digital gold, store of wealth, a way to hedge against inflation. They see Ethereum as a cash flow driven technology play that is providing an Internet 2.0 and a new way for finance to exist in the world. And they love all the real world applications. In February of this year, after it was clear that the Bitcoin ETFs were a huge success, 4 major bank lobbying organizations, the American Banking Association, SIFMA, a couple of others, put out a letter saying, we want to reverse SAB 121. The reason for that was, purely greed-based, right? Because they saw all the money being made in Bitcoin custody and they wanted banks to play a role. So when the SAB 121 reversal came out, I thought, well, crypto is celebrating its political force, but the real story here was Wall Street with its lobbying money said, hey, we want in on this game.
Matt Hougan begins by emphasizing the strong demand for Ethereum and crypto assets within an ETH wrapper. Professional investors prioritize diversification, a fundamental principle taught in business schools, and this principle extends to cryptocurrency investments. Most investors do not hold a single stock or bond, and similarly, they seek to diversify their crypto holdings beyond Bitcoin. A Twitter poll conducted by Hougan revealed that about half of the respondents who own Bitcoin ETFs are interested in adding Ethereum ETFs to their portfolios. Considering that Bitcoin ETFs represent approximately $50 billion in assets, this indicates a significant potential market for Ethereum ETFs. Hougan explains that financial professionals have a distinct appreciation for Ethereum, viewing it differently from Bitcoin. While Bitcoin is often seen as digital gold, a store of value, and a hedge against inflation, Ethereum is perceived as a cash flow-driven technology platform that underpins the next generation of Internet 2.0 and decentralized finance DeFi.
There's a lot of demand for Ethereum, and there's a lot of demand for accessing crypto in an ETF wrapper. So when you put those together, you should expect there to be significant demand for this ETF. A few reasons for that. From a starting point, professional investors love diversification. Literally day one, when you go to Investing 101 class at business school, the first thing they drum into you is always diversify. So you have, no one holds one stock, no one holds one bond. Most professional investors don't just want to hold one crypto asset. So I think you're going to have a large number of people who have exposure to Bitcoin ETFs who now also want exposure to Ethereum ETFs. I did a Twitter poll yesterday and asking people who own the Bitcoin ETF if they were going to add ETH, and about half of them said they would. And remember, that's $50 billion of assets, right? So it's significant exposure. Bitwise, of course, sort of historically is built on a multi-asset framework. Our first product was an index-based product. We talk to investors about Ethereum all the time. And that leads to my second driver, which is financial professionals love Ethereum. And it's a very different story from Bitcoin. They see Bitcoin as digital gold, store of wealth, a way to hedge against inflation. They see Ethereum as a cash flow driven technology play that is providing an Internet 2.0 and a new way for finance to exist in the world. And they love all the real world applications. I think all you need to tell a financial advisor or professional investor about Ethereum is, you could talk about stablecoins, digital dollars on a blockchain. You could talk about BlackRock choosing to launch its first tokenized fund on Ethereum. You can talk about the growth of DeFi and cash flow. I think there's going to be significant demand for these. And the other piece of that that's really important and different from Bitcoin is there's no new supply. There's no new supply. Net supply is effectively zero. I know it's been up a little bit recently, but it's effectively zero over a long time frame. And what that means is that this new demand shock has to buy Ethereum from people who don't have to sell it. And that's just an extraordinarily bullish setup. So I think there will be real demand for these. When I talk to advisors, there's real interest. I can't wait to talk to people about, Ethereum within an ETF context if we get to. And I think these will be a huge success. I don't think Ethereum ETFs will match Bitcoin ETFs, but I do think it will be measured in terms of many billions of dollars. So I think the $10 billion will convert. Some of that will be people selling out, and so it will have to have people catching up to buy it. But then could we get 5 additional $1 billion into Ethereum ETFs by the end of the year? I certainly think that's possible. Could there be significantly more in future years? I definitely think that's possible. Will it be enough to drive Ethereum to new all-time highs? I definitely think that's possible as well. So, looking out, if Bitcoin ETFs did 13 billion or 12 billion in their first 4 months, let's say, I think Ethereum ETFs will do less than half of that, but more than a quarter of that. And that's going to be pretty significant, right? Remember, that's against a market with no net new supply.
Right.
So I think there is real demand. The ETF investor market, if I had to put numbers on it a year from now, I think you'll have 30% of the market that's Bitcoin only. You'll have like 50% of the market that's a mix. You'll have 20% of the market that's ETH only. So I think it'll be really significant. I think many professional investors looking at the crypto market are looking for sort of tech alpha. They're looking for that high returning asset. Ethereum fits nicely into that dialogue. So I think you'll see all three. And I think the market as a whole will benefit from there being multiple crypto asset ETFs, if that's what we get. It makes the market feel more robust, more real. There's more to talk about. I think it'll be a net positive. So, these are going to be significant. They're going to be significant. So the first thing we saw was the SAB 121 reversal. And my view at that time was that the primary driver was Wall Street starting to lobby on behalf of that specific example. You may remember, maybe not, in February of this year, after it was clear that the Bitcoin ETFs were a huge success, 4 major bank lobbying organizations, the American Banking Association, SIFMA, a couple of others, put out a letter saying, we want to reverse SAB 121. The reason for that was, purely greed-based, right? Because they saw all the money being made in Bitcoin custody and they wanted banks to play a role. So when the SAB 121 reversal came out, I thought, well, crypto is celebrating its political force, but the real story here was Wall Street with its lobbying money said, hey, we want in on this game. And
the banks wanted it done.
They wanted it. And I thought that was a defining characteristic. But what happened on the FIT 21 bill was something different, which is that bill doesn't specifically help Wall Street. That actually paves the way for a bankless nation to disrupt Wall Street in major ways. I know that it's not a perfect bill, but it does point in that direction, right? It talks about having these be commodities. It talks about them being regulated on the CFTC. It talks about normalization. It paves the way for DeFi and other aspects where banks aren't going to benefit. And that told me that the real winner here, or the real driver, of course, there are many sort of fathers and mothers of success, but the real driver was crypto's burgeoning political force. And the reason that's important is that there are many things that Wall Street will want out of crypto: custody, stablecoins, a few other things. But there are many things that it won't want. It won't want self-sovereignty. It won't want the free speech element. It won't want the disintermediation. The fact that it was crypto's political force driving this change tells me that those things are in play. And that makes me very optimistic for where this industry is going.
Hougan provides a comparative analysis, suggesting that the market for crypto ETFs will become more diversified. He envisions a future where 30% of the market consists of Bitcoin-only investors, 50% hold a mix of Bitcoin and Ethereum, and 20% are Ethereum-only investors. This diversification will make the crypto market more robust and real, enhancing its appeal to a broader range of investors. The regulatory environment also plays a crucial role in the growth of crypto ETFs. Hougan discusses the impact of regulatory changes, such as the reversal of the SAB 121 rule, driven by Wall Street's lobbying efforts to benefit from the lucrative Bitcoin custody business. However, he highlights a significant shift with the FIT 21 bill, which aims to regulate cryptocurrencies as commodities under the CFTC, paving the way for DeFi and other innovations that could disrupt traditional banking.
Because most of these people have no idea why there's more than one crypto asset. They think of Bitcoin and Ethereum like they think of the dollar and the euro, because they're both currencies. And what I tell them is that's the wrong way to think about it. The right mental model is to think about different software companies. We accept that different software companies use software in different ways. Salesforce uses software in one way, Microsoft uses it another way, Snowflake uses it another way. And there are a wide variety of software companies that optimize software to do different things, to do CRM, to do Word, to build Slack, etc. Crypto assets are the same. Every crypto asset is two things. It's an asset and a blockchain. The Bitcoin asset, the Bitcoin blockchain, the Ethereum asset, the Ethereum blockchain. And those blockchains can be optimized to be good at different things. Bitcoin was the first, and it's a very simple piece of software. Basically, you can send Bitcoin, receive it, hold it, destroy it, do some very simple if-then statements. Every decision it makes is based around the concept of maximizing security and decentralization, right? So as an example, it doesn't upgrade very often. Why? Because upgrades introduce some level of technological risk. The downside of not upgrading very often is your software is static and it can only do a few things. But if you're designing to be digital gold, all you care about is that it's extremely secure. And so every decision you're going to make is going to be, does this ensure that it's extremely secure? You don't care if it can do a lot of things. You just want it to be able to store wealth. And that's what Bitcoin is. Ethereum looked at Bitcoin and said, it's cool that you can store wealth and teleport it around the world. What if we could program it to do everything? What if we could program it to act like the New York Stock Exchange? What if we could program it to act like a lending agent, like a bank or a prime broker? What if we could program it to host sort of who owns digital art or host digital dollars? There's a trade-off to being that flexible, which is that on the margin, it's less secure. It's not going to be, it's going to update more. It's going to take on more technological risk in order to be more functional. And so what I tell advisors is, if you want to invest in digital gold, that's Bitcoin. If you want to invest in using blockchains to do many more things, that's what Ethereum is, right? You have Uniswap that's built on Ethereum. It's trading billions of dollars of crypto assets. You have stablecoins that are built primarily on Ethereum that's putting US bank accounts on every phone everywhere around the world. You have BlackRock that's moving funds from the traditional system into the crypto system, and they're choosing Ethereum. There's more to finance than just gold. There's everything else. Bitcoin is gold. Ethereum captures the rest of this market. And if you want to invest in crypto, you own both. If you want to invest in one or other, you pick one or two. But that's usually how I start describing it to people.
Hougan makes a compelling case for understanding Bitcoin and Ethereum as distinct yet complementary assets. Bitcoin, designed as a secure, decentralized store of value, serves as digital gold. Its simplicity and focus on security make it a reliable store of wealth. On the other hand, Ethereum is a more flexible platform, capable of executing complex functions like acting as a decentralized exchange Uniswap, hosting digital art NFTs, and facilitating digital dollars stablecoins. This flexibility comes with trade-offs, including higher technological risks and less inherent security compared to Bitcoin. The choice between Bitcoin and Ethereum depends on their investment goals. Those seeking a digital store of value might prefer Bitcoin, while those interested in the broader applications of blockchain technology and decentralized finance might opt for Ethereum. Hougan emphasizes that both assets have unique roles and can complement each other within a diversified portfolio. The presence of multiple crypto asset ETFs will likely benefit the market as a whole, making it more attractive and credible to a wider range of investors. Please like and subscribe my channel.